The SharePickers Podcast.
And joining me on the podcast right now and on video, Vadim Alexandre, Head of Healthcare at SP Angel. You all right, fella?
How are you doing, Justin?
Yeah, good then. Let's get straight to a hot topic, because I posted yesterday on Twitter. And in fact, let me just find this. I'll read out for you exactly what I posted, because I may miss something out. But and it had a bit of a reaction, basically. Here we go. I'll share the screen with you so you can see it. And this is what I said, and I want to get rid of this control here. I said, if you look at the companies delisting from AIM, they've been listed close to a decade or more, are still high cash burn businesses who need to raise more money. Their share prices are a fraction of where they are when they're listed. Are investors really going to miss them? Companies who have used AIM to raise money and grow and become profitable will not delist. How long do you give a company before it starts generating money? Surely 10 years is enough. AIM has a reputation for eroding shareholder value, but this is largely down to companies at the bottom end that will never produce anything apart from more shares. To improve this perception, we need more of the low-quality companies to delist so high-quality businesses remain. The types of businesses that can give investors a positive return on investment, at least within a decade. This will help AIM change its reputation for the better and attract more investment liquidity. Now, I wasn't just referring to, ETX, so I'm sure it's a great company, and we've looked at it, and it has something, but that's the way it is, isn't it? I mean, this company hasn't returned anything for investors, and I just think it's part of the reason why AIM has a bit of a bad name, because this is where the share price started, 65 pence back with IPO, and it's now at 12 pence. So I understand, there may be some valuable tech to come out of this, but maybe they're just not ready for AIM. Maybe they're not there. Maybe companies should have a goal of actually getting to, cash generation within a certain time frame, because eventually it just keeps draining, private investors of money.
Yeah.
Now, what's your thoughts, Vadim?
So basically, ETX it's more complicated than that on this one. I think, look, you're absolutely right in your point on that's how markets should work. Companies that are not going anywhere should be delisted, right? So if they're, there's no arguing with that. I couldn't agree with you more. I think what we're seeing more recently is a little bit different. We're seeing what I would call good companies delist, okay? And that it doesn't mean that's always the case, and good is in the eye of the beholder. But here's my case as to why there's a small trend in the wrong direction. And it's not necessarily a definitive trend. It's just we've seen a couple of companies in healthcare delist that have actually delivered. One is C4X, okay? And they've had, they're delisting after having struck an agreement with AstraZeneca, and they're actually delivering now, C4X. It just so happens that these companies are hitting, I guess, some investor apathy at a time when the markets are particularly bad and sustained in what I would call now pushing a 3-year downturn in biotech, right? So, C4X was a drug development business, that has done quite well, not in terms of share price performance, but that's their gripe. That's why they're getting off the market. But in terms of delivery within their business, okay? ETX, in its own way, has been progressively delivering, and more recently, okay? Now, you have C4X there. So if you look up ETX, let's go through the kind of the history a little bit, because a lot of it, unfortunately, doesn't apply. It still, makes your point. Maybe they should have delisted before the current management team got involved. But the history from way back when is under a different management team, developing small molecules, doing something completely different. Okay, they always had an engine. They always had their in silico engine. Okay, and that's been developed up further under the new management team. But when you look at 2020, there see the trough. So right before that big rally, that trough is when roughly 2019, 2020 is where the new management team got involved and developed the company into an RNA silencing business / using the AI, using their in silico engine, and developed it into an AI powered, or if you like, a stronger engine. Okay. So over that period, huge value created. Stock, hit 50p from about lows of 2p. I literally think they got involved when it was about a 2p stock. So a lot of people made a lot of money out of this stock, and they got in right around that time or anywhere on that up cycle and sold, 40, 50p. Okay. Then came the downturn, and that stock performance is in line with pretty much everybody else's stock performance. Okay, so you've got a company that's gone from highs during COVID all the way down to roughly about 12, 13p today. Still a 75 million market cap business. The whole time, though, the company is evolving and producing results. Okay, so yes, the funding environment impacts these businesses and it's important to them, but this company, this is the main point, has found financing in that period, and predominantly through two key cornerstone institutions, namely M&G and Aura. Okay, and I guess the final kind of nail in the coffin for them was that they went out, tried to raise the money with incremental financing. They had the two cornerstones in place to the tune of about 30 million quid, I think 28 million, 29 million, as you see there. And there's just very little appetite for preclinical businesses. And that is indeed the case. And so their thinking is probably that, what's the point? And the last thing is that you look in the US market for this particular area, RNA silencing, and it's had a huge rally. There's a sister company called E-Therapeutics that's roughly $1 billion market cap business. It is further ahead, but you can see how companies now are looking at that arbitrage and saying, well, we're funded. Do we need the hassle here? Let's look towards a future US listing. And that's what they're saying in all their announcements. So yeah, it's disappointing for UK markets, without question, I think. Do I think it's for the reasons you mentioned, that they're failing businesses? I don't think that's the problem we're seeing with some of these delistings these days. What I think is the US markets are often ahead of us, so they rally before we rally. I do think the US biotech market is starting to warm up. It's not across the board. It's starting to heat up. Certain sectors like RNA silencing in E-Therapeutics case are ahead of the rest of the biotech market. So they're hotter, if you like. And it creates that problem, that we suffer through many cycles in the UK, is it takes longer for our markets to bounce back. And some companies we lose some companies to that. We've seen other companies go to the US. It's a trend. It's a problem. It's well telegraphed. I think ARM was the big one, right? Remember the ARM listing that?
So why can't they say they struggle to get sufficient engagement from the vast majority of institutions who are approached, reflecting the risk appetite of UK markets. So that's interesting, isn't it? That because there are companies getting places away, and you've got to think, well, they're blaming, institutions there, but is it there? Are they? Sharing the story? Are they inspiring investors? Because but the thing is, for me, I'm thinking, how long can you keep going raising money for? There can't be an indeterminate amount of time. There must be a time when you say now, 10 years is
absolutely valid. I couldn't agree with you more. These are all things that people, investors need to see results that are tangible. They need to see.
The sad thing is here. The sad thing is, yeah. Do you know the sad thing is? You said there, C4XD and ETX seem to be, progressing and developing.
Yeah.
There are plenty of resource stocks on the market who are not. Basically raising money for like 20 years. They haven't gone anywhere. They're still doing it. And this downturn probably won't cancel them. They'll still be doing the same thing. There's going to be some kind of cleansing mechanism to get some of these zombie companies off there, because it is sad. Like C4XD, I held them a while back, and it seems to be. Richard Griffiths is involved in both these, isn't he? C4XD and ETX. Yeah. Is it him saying that it's no good? Let's get it off the market. He seems to be having the say here.
Yeah, well, look, without question, Richard Griffiths is an activist investor, and I'm sure these things aren't happening without his blessing. You know what I mean? He's putting 10 million, whatever, how much is it? I don't remember exactly, but that 28 million pounds, 28.9 million pounds is substantially in the form of two shareholders, which is Aura Richard Griffiths and M&G, right? Yeah. So I guess my main point is that's a significant amount of money supporting these businesses, right?
Yeah.
Now, do they need to be told we're not interested by investors in the UK anymore? What do you think? I mean, if you've got the lion's share of your financing that's keeping your business going, do you need to put the time in anymore here,
Yeah.
right? So that's probably part of the problem here, and testament to whether they're good businesses or not. That's a serious amount of money. Someone supports them, and it's not a trivial amount of money that they've raised, right? So that's, I guess that's the ultimate. So, do I think what you're saying is, I totally agree. There should be a cleansing mechanism to get rid of, lifestyle businesses and zombie companies and all that. What I think we're seeing here is a little bit of a kind of consequence of a long downturn, right? We're seeing a very, very difficult downturn here that is gone beyond kind of your typical length. And the UK is, just slow to bounce back, and the US is starting to bounce back. So there's a bit of an arbitrage. People are leaving. They're leaving.
Do you know what's worrying though? I don't know if you saw the figures. Obviously did yesterday on CPI, came in a little bit hotter than expected. It shook the market, it rattled the US markets a little bit, which have rallied like crazy. I mean, the S&P. I was at the S&P yesterday, right? And it's crazy where it is really. Look at that 200-day moving average. Look at the share price, right? That's about 13% above it. Yeah. I look back at times to be like, is this a bubble? And of course, it's driven largely by the Magnificent Seven, the big stocks there. Yeah. And I look back. And literally, you can count on 3 fingers whenever it's been that high above a 200-day moving average, even back to the last 20-odd years. Yeah. So you're thinking, it is overcooked. And I think now what's worrying is you've got Europe. I mean, America's economy is strong. It's doing very well. They put 3,000 jobs on recently. Yeah. And so there's no chance they're going to reduce interest rates because the economy is doing well, the employment's doing well, people are spending, and yet CPI is still quite high. So inflation is above target. But in Europe, it's a different story. Yeah. I mean, we're not growing. Germany's not growing. It was better than expected manufacturing, but still, we've been in recession. So I think we've got a case here. We can say, when does the Bank of England start worrying about growth rather than inflation and saying, okay, we weren't going to go before America because if we reduce our interest rates before them, it could impact our inflation. But when you're struggling for growth, thinking, it's not going to happen. We're not going to get inflation because growth is not there. So I think we could see a situation here where we reduce interest rates, the market's starting to rally, US investors pile into UK and Europe because they really see that the American market's overcooked a little bit.
Well, this is it.
I mean, could have a good rally in Europe and US.
Companies all the time.
Companies like C4X, but companies like C4X and E-Therapeutics, they may go to America in the downturn, and they may go at the bottom here and go to America in the downturn. So I don't know if that's going to happen, but I mean, I still do see money inflow. I mean, if you look at AIM, for example, AIM is like 50 points away from a bull market. The bull market's here, and we're starting to rally. Look at this. So.
I mean, I like you. I'm a bull on our market because I genuinely feel that it's good value. The thing that I think in the US is that hasn't happened though is the trickle down into the Russell 2000. The rally there is still not widespread. It's not broad across the market. It's still the Magnificent Seven. It's starting to spill over.
Well, it's a little bit Russell starting to rule a bit, but it comes off a lot heavier as well. I mean, it's broken up.
But it started. It started. It's not seen the rally that Nasdaq has seen or the Magnificent Seven have seen. It hasn't seen. It's like the 25% rally, which isn't a bad rally. I mean, AIM has seen some of that rally too.
14%, yeah. But it's very funny. You're right. I think the Americans, rattled by that interest rate, and I thought there was no communication from central banks they're going to raise interest rates in June. Everyone's talking the market up like this. I don't see why they worry. The economy is still powering along with 5% or 5.5%, 5.25% interest rates. So what's the worry? What's the worry? You're still, as long as you keep doing that, keep performing, there's no worry. I mean, I think it's a bigger worry in Europe and UK not getting growth. So,
I genuinely believe that the interest rates at this high, this long, have an impact. It's slamming the brakes more than we need to, and we're overshooting. But then again, are we going to change the central bank's policies? No, we're not. The inflation came in a bit higher in the UK too. So they have a dilemma. They can't lower rates in a high inflationary environment. 3.5% in the
3.5 down to 3.4. Yeah, I just want to look at quickly because I know this is in your area. I looked at Novacyt today and I thought, okay, because they released some news on directed changes and they pushed their results out a little bit. Yeah, and I looked at the last trading update, right? And they bought Your Gene Health, didn't they? Yeah. And I always remember them having 80 odd million of cash. Look at this cash position at 31st of December, 44, down from 81.
Because of the acquisition.
They bought, but your gene cost them like 17 million, and they've like burned 33 million with costs. So what? So I just plugged. Why it was a little bit late? I plugged them into my website on the MicroCap League, and I'll show you Novacyt, and it's literally. If you look at this, the growth is there, but look at that. Operating loss, 23 million. It's literally, I'm thinking, this is not good. So this is the last set of results here, interims. They went from 16 to 3, cash down there. And I thought, this is not good. Every metric is apart from health, because they've got cash, is in the red. Look at that, 80% drop. And I thought, where did they get to? How is that they've got, that cash is already gone? I thought, that's unbelievable.
Yeah. So there's the acquisition, then the costs, and then the burn, right? So the triple compound, if you like, of the situation. Definitely.
That's So that's and I can't see. There's no forecast at this, but I mean, but they are going from 92 million, then 21 million, and now at 11 million. So almost more than half again. So at what level do they start? I've just put in some 5% growth there and see where it's gone to. But at what level do they come back? So I mean, it's and I always thought that 18 million, but they've also got that court case thing, haven't they? So,
I think that's don't get me wrong, those metrics are difficult, right? But the court case is imminent. It's in June, so that nothing really can happen. But I mean that is the situation. I think this is one of these great victims of the decline of COVID sales. The 91 million was all COVID. It was all
exactly
all COVID sales. So that testing is gone. Through, as you saw.
Just one other thing quickly. Sorry, I'm keeping you, but you're in this area of where you guys biotech companies delisting and all that. What's the thoughts around this? I mean, is there any thoughts? Like, is there more likely to happen, or what? Because I mean, I can assume there's lots of biotech companies out there, CEOs, whinging, probably, concerned about the share price. And is this now a trend going to happen, or do you think it's just
it feels like a trend over the last couple of weeks, but I guess ultimately one has to decide, can you find financing? And that's just the bottom line. Public markets offer a form of financing irrespective. There's always, may not be at the price people like, it may be, but it is a mechanism for financing businesses. Primarily the reason that they list to begin with, right? So, ETX's case is completely different. They have 29 million. Okay, the financing isn't the issue, right?
Yeah.
So, but most companies don't have that luxury and aren't in that position, which is my point. That's why I think ETX is a strong business, because it's proven by the fact that there's so much money put into it. But most businesses don't have that luxury, and should they be delisting without a financing plan? I would say that's a high risk decision. Very high risk decision. So I think the break on any trend is that. Now, we could also have a scenario where this is a prolonged downturn indefinitely, and that's that could create all kinds of harms to the market, which is soon to be seen. I hope that we are actually in an upturn. It's certainly the case in the US. It's starting, and more often than not, we follow. And why? Because the asset arbitrage that you described between the Magnificent Seven and the rest of the world just cannot sustain itself indefinitely.
Exactly. People go looking elsewhere. Yeah, exactly. And that's always the thing. It's like, you get some people obsessed with one stock, but generally most investors, they have a good rally in a stock. And if it's sitting up there for ages and going nowhere, you start looking around and think, I'll take a bit of profit from this, I'll look elsewhere. And that happens, globally. I mean, there's plenty of, American fund managers and family offices, running the rule over Europe because they've seen the rally happen in the US. It's now going to be petering out maybe. And so they're thinking, and we know that many, UK companies have been bought out by US companies. So it's going to happen more and more, especially if interest rates come down. That'll really stoke up the markets, I think. So that could be happening.
That's how I feel about the next, say, 12 months, the next year. Is that we'll see a surprise on the upside. But let's hope.
Marvellous stuff. Sorry, Vadim, I kept you for longer than 10 minutes, but you're worth it. Thanks very much. And we'll speak to you next week.
Thanks, Justin. Speak soon. Take care.
The SharePickers Podcast with Justin Waite. The content of this podcast is not intended as investment advice. It is for information purposes only. People in this podcast may hold positions in the stocks they talk about. Do not buy anything based solely on a tip or recommendation. Please do your own research.